Hey everyone, and welcome back to our channel Trading Critique. Today, we're getting down to business and talking about something fundamental to Forex trading, Forex sessions. Now, the Forex market might be open 24/5, but that doesn't mean it's a constant party. Different parts of the world take the lead at different times, and understanding these sessions is crucial for any trader, beginner or pro. So, buckle up, because in this video, we're going to unlock the secrets of the Forex market clock. What are Forex sessions? The Forex market, unlike the stock market, never sleeps. It's a 24/5 operation, but that doesn't mean there's constant, equal activity throughout the day. Imagine the Forex market as a giant relay race. The baton, in this case, represents currency trading dominance. As different financial centers around the world wake up and traders get to work, they take over the lead, influencing currency prices. These periods of dominance are called Forex sessions. There are three major players in this game. Tokyo session, 3 a.m. to 12 p.m. Greenwich Mean Time. This is the Asian session, kicking things off in the East. Tokyo is a major financial hub, and traders here are known for their cautious approach, often consolidating on previous moves. London session, 12 p.m. to 5 p.m. Greenwich Mean Time. Next up, we have the European session, dominated by London. This is the most active session, with high liquidity and the potential for strong trends as traders react to economic news and market events. New York session, 5 p.m. to 9 p.m. Greenwich Mean Time. Finally, the baton passes to the North American session in New York. Here, traders often continue trends from London or initiate reversals based on their own economic data. These are the big three, but there are also minor sessions like Sydney and Frankfurt with lower trading volume. Now that we know the players, let's talk about how Forex sessions impact something crucial for traders: volatility. Think of volatility as the intensity of price movements. A chart with wild swings is highly volatile, while a flat line indicates low volatility. The key thing to remember is that session overlaps create the most action. When major sessions like London and New York are both open, you see increased trading activity from both regions. This often leads to higher volatility, as more buyers and sellers compete in the market. On the other hand, quieter sessions like Tokyo can be good for range trading strategies. Here, price movements tend to be more contained within a specific range, making it easier to identify potential entry and exit points. So, how can you identify these volatile and quiet periods on your chart? Most Forex platforms display session times. You can also use historical charts to analyze past volatility patterns during specific sessions. By understanding session overlaps and how they affect volatility, you can choose the right trading approach for the time you're active in the market. Alright traders, that's a wrap on Forex sessions. In this video, we explored how these timeframes impact the market, from volatility to strategic opportunities. Remember, Forex sessions are like understanding the rhythm of the market. By knowing when things heat up and slow down, you can make informed decisions about your trading approach. We'll be diving deeper into specific Forex trading strategies in upcoming videos, so stay tuned. If you enjoyed this and want to level up your Forex knowledge, don't forget to hit that subscribe button and smash the notification bell so you never miss a video. Thanks for watching, and happy trading!